If you stay, I'll teach you everything you need to know about technical analysis. Let's start with the market structure. Market structure is the backbone of technical analysis. It's about figuring out who's in control, demand or supply, buyers or sellers. When demand and supply influence price movement, trends are born. An uptrend or a bullish trend is characterized by higher swing highs and higher swing lows. This trend remains intact until a lower low emerges. A downtrend or a bearish trend shows lower lows and lower highs, and it continues until a higher high appears. Markets don't always trend. They can transition into consolidation phases or a sideways trend. A sideways trend displays roughly equal highs and lows, with price consolidating in a range. To identify the shift from trend to consolidation, watch for failed tests of recent highs and lows. To confirm a healthy trend, look for price to break and close above or below previous highs or lows. Multiple closes beyond these levels indicate strong momentum. A failure to hold above or below suggests a potential false breakout. Lastly, keep an eye out for the breaks in market structure. In an uptrend, a break in the market structure occurs when price makes a new lower low and a new lower high, indicating potential weakness or reversal. Similarly, in a downtrend, a break of structure happens when price forms a new higher high and a new higher low, serving as a warning sign. All markets move in cycles, which are accumulation, markup, distribution, and markdown. Accumulation is when the price has fallen to a point where the price may seem stuck in a range. In this phase, buyers are quietly gaining strength. In the markup phase, the buyers finally break free from the range and start pushing prices higher, confirming that the buyers are in control. In the distribution phase, after the previous significant price increase, sellers start to regain control and the price action flattens out once again. Lower tops and flat bottoms characterize this range as the sellers prepare to take over. Finally, the markdown phase arrives and the sellers steer prices below the lower level of the distribution phase and a strong downtrend emerges. If you can spot the end of the accumulation stage, be ready to buy at the beginning of the markup, riding the wave of rising prices. Similarly, if you can identify the end of the distribution phase, be ready to sell and profit from the markdown's downward momentum. Mastering support and resistance is very important in technical analysis. Support acts as the floor beneath the market, an area where the price has shown a tendency to stop falling. Buyers might see value at this level and start buying, creating a demand zone that prevents the price from dropping further. Resistance acts like a ceiling above the market, an area where the price has shown a tendency to stop rising. It's like an invisible barrier that keeps prices from moving too high. Sellers might see it as a fair price to sell their positions, creating a supply zone. This is how you spot these levels. First, look for the extreme swing highs and lows, the highest and lowest points the price has reached recently. Also, look for at least 2 rejections of an area. The level should be obvious, jumping right out at you when you glance at a chart. Also, the move away from the area should be significant. Another condition, the level should have acted as both support and resistance, respected from both sides. And finally, the level should have been recently respected or formed. You don't need all these conditions to draw a level, but the more rules it fulfills, the better. Now, very important, the more times a level is tested, the weaker it becomes. Really strong support and resistance levels immediately push the price away from them. If the price can hang around or quickly revisit the level, it suggests a lack of conviction from buyers or sellers. Multiple tests of a level can set the stage for a breakout. And another tip, when drawing support and resistance, focus on the significant levels rather than cluttering your chart with every possible level. And very important, treat these levels as zones rather than exact lines, as the price might break your line or turn before touching it. Candlesticks give you a visual representation of the battle between buyers and sellers. Each candlestick reveals the open, high, low, and close price for a specific time period, whether it's a minute, an hour, or a day. The candle body represents the distance between the opening and closing price, while the high and low show the extremes reached during that time period. The length of the candlestick body and the wicks are revealing the buying and selling pressure. A long upper wick suggests strong selling pressure, as sellers drove the price down from the high. A long lower wick indicates strong buying pressure, with buyers pushing the price back up from the low. Short wicks imply minimal buying or selling pressure. A long body indicates strong buying or selling pressure, while a short body suggests less intense activity. Sometimes you might see candlesticks with no wicks at all, just long bodies. These are momentum candles, emphasizing the market sentiment even more strongly. Also, pay close attention to engulfing bars, which appear when a larger candle engulfing a smaller one, and to pin bars with their long tails and small bodies. Also look for inside bars when one or more candlesticks that are completely contained within the range of a larger candle. The real magic happens when you combine these candlestick patterns with the right context and you analyze a series of candles within the broader price trend. So observe how candles form in relation to previous bars and look for engulfing candles, inside bars, and pin bars at major levels of support and resistance or during significant trend phases. A group or series of candlesticks form price patterns. In technical analysis, we can have reversal patterns, which indicate that the price might be about to change direction, or continuation patterns, which signal the price will likely keep moving in its current direction. Double tops and bottoms are the most important reversal patterns worth watching. A double top happens when the price fails to make a higher high and instead matches the previous high, hinting at a potential bearish reversal. A double bottom is the opposite. The price fails to make a lower low and matches the previous low, suggesting a bullish reversal could be on the horizon. Continuation patterns appear as consolidations after a period of trending. Ascending and descending triangles have a clear directional bias, with buyers or sellers showing their strength. Flags and wedges slope in the opposite direction of the prevailing trend, hinting at a potential continuation. Rectangles form when the price consolidates sideways, bounded by clear support and resistance levels. Very important, location and context of these patterns are crucial. A continuation pattern is only useful if there's an existing trend to continue, and a reversal pattern needs a trend to reverse. Also, be aware that we can sometimes see what we want to see, so it's important to stay objective and don't rely too much on patterns. No pattern is foolproof, and they will fail a lot. It's often easier to spot them after the fact. Textbook patterns are rare in real life, so be prepared for price spikes and fake breakouts. Fibonacci retracements are one of the most popular tools in technical analysis, and they work best when the market is trending. The theory behind this is that after a trend begins, the price will often retrace to a previous level before continuing in the direction of the trend. To find these Fibonacci levels, you need to identify recent significant swing highs and lows. Then, you use the Fibonacci tool to connect the swing high to the swing low in a downtrend, or the swing low to the swing high in an uptrend. The idea is to buy when the price retraces to a Fibonacci support level during an uptrend, and to sell when the price retraces to a Fibonacci resistance level during a downtrend. Choosing the correct price swing is crucial when using Fibonacci retracements. Focus on larger time frames and avoid using the tool on very small price moves, as the levels will be too close together to be reliable. The best Fibonacci retracements are those that are easy to spot on a chart without having to look too hard. Now let's talk about supply and demand zones. These areas are formed when big market players are placing large quantities of orders. A demand zone is where buyers are likely to step in and start buying, causing the price to go up. A supply zone is where sellers are likely to enter and start selling, causing the price to go down. In theory, if price returns to certain supply and demand zones, it has a high probability of rejecting these areas. This is how to mark supply and demand zones on your charts. First things first, you'll need to identify the overall trend. Next, look for significant turning points in the price action. These are the points where the price made a sharp reversal, either from a low point or a high point. To mark a demand zone, find a low point in the market where the price bounced up strongly. Locate the last bearish candle before the price move. Then draw a horizontal line at the low point of the candle and another one at the high point of the candlestick. This is your demand zone. To mark a supply zone, you find a high point where the price fell sharply. Locate the last bullish candle before the price move. Draw a horizontal line at the high point and another one at the low point of the candlestick. And this is your supply zone. When marking zones, focus on the most recent and significant zones. Older zones may not be as relevant anymore, and adjust your zones as needed. If the price breaks through a zone decisively, it may no longer be valid. Volume is also important in technical analysis. It basically tells you how much trading activity there is in a given period. When volume is high, it means there are a lot of market participants involved in the move, including the smart money, the big players who bring the most turnover. This is a good sign because it confirms that the market activity is real and not just a fluke. On the other hand, low volume suggests that there aren't many traders interested in the current price levels, which could mean that the trend is running out of steam. Volume can also help you evaluate the health of a trend. In an uptrend, you want to see volume increasing as the price moves higher, and you want to see it decreasing during pullbacks. If volume is decreasing while prices are rising, it's a warning sign that the uptrend might be losing momentum. Another important thing to watch for is volume spikes at certain price levels. Look for periods when volume suddenly jumps up. It means that a lot of traders are interested in that particular price. If the spike is really big, like bigger than any other recent spikes, it's called a volume climax. Volume can also help you validate breakouts. When a market is consolidating and trading sideways on a low volume, a sudden increase in volume could mean that a breakout is coming. If the breakout happens with rising volume, that's a good sign that the breakout is legit. But if the breakout happens on low volume, it might be a fake out. Elliott wave theory is all about identifying repeating movements on price charts, which are called waves. These waves can be either impulsive or corrective. Impulsive waves represent the direction of the current trend. Corrective waves work against the prevailing trend and are usually weaker and less aggressive. An uptrend typically has 3 large upward price impulses and 2 corrections, creating a 5-wave pattern. This uptrend is then followed by 3 waves lower, an impulse down, a correction to the upside, and another impulse down. There are 3 golden rules in Elliott wave theory. Wave 2 cannot go past the start of wave 1. Wave 3 cannot be the shortest wave, so wave 1 or wave 5 or both must be shorter. And wave 4 cannot go into the price territory of a wave 2, so waves 2 and 4 must have clear price separation. It's best to trade in the direction of the impulse waves, as they represent the largest price moves. So in an uptrend, buy during pullbacks or at the end of a corrective wave and ride the next impulse wave higher. In a downtrend, sell at the end of a corrective wave to profit from the next impulse wave down. Now let's talk about market gaps. A gap happens when the price jumps higher or lower from the previous price, leaving an empty space between the 2 prices. This happened because of an imbalance between supply and demand. An up gap forms when a candle's low price is higher than the previous candle's high price. A down gap is the opposite. The high price is lower than the previous low price. Gaps show that something significant has changed in the fundamentals or the psychology of the market participants. There are four main types of gaps. First, we have common gaps. These gaps are normal, small, and happen fairly often. They usually get filled quickly and don't provide much insight. A gap fill is when the price action retraces to the level before the gap. Breakaway gaps occur when the price breaks out of a trading range or congestion area. They need market enthusiasm and a significant increase in volume to happen. If the volume increases when the gap occurs, it means the new trend has a good chance of continuing. Runaway gaps happen in the middle of a strong trend and show that the trend is accelerating. They're a sign of increased enthusiasm and usually happen with high volume. Exhaustion gaps occur near the end of a strong trend, and they're often followed by a sharp reversal in the opposite direction. Exhaustion gaps are usually filled quickly, signaling the end of the trend. Technical analysis relies heavily on trading indicators to show various aspects of price activity. These indicators can be divided into four main categories: trend following, momentum, volume, and volatility. Trend indicators like VWAP and moving averages measure the strength and direction of a trend. They have a main drawback: they lag the price and give trading signals after a trend has already been established, causing you to potentially miss the initial move of a new trend. Momentum indicators, also known as oscillators, measure the relative strength of recent price moves and plot a value between 0 and 100. They work well in ranging markets, but can lead to false signals when markets are trending. RSI and MACD are the most popular oscillators. Volume indicators measure the strength of a price move using volume information. You can use the standard volume, money flow index, or the on-balance volume. Volatility indicators, such as Bollinger Bands and ATR, measure the rate of price changes regardless of their direction. These indicators are rising when markets are fast and falling when markets are slow. Indicators should confirm your trade bias, not be followed blindly. Let them be a tool in your arsenal, but don't rely on them entirely. Now, if you like this guide, you definitely must watch these next trading tutorials.